Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I am Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers ranging from emerging to established franchise VCs. And today I'm once again flying solo as my GP co-host Nick is settling into his first few weeks of becoming a parent. And while we're missing him on the mic, I'm excited to continue our LP miniseries on franchise funds, where we speak with some super impressive and reputable LPs to uncover first what a franchise fund means, and then second, the journey one must take to become and stay one. I'm incredibly excited to pick up the conversation with someone whose track record speaks for itself and can give us the inside scoop on all of this. Jessica Archibald is a GP and member of the investment committee at Top Tier Capital Partners. There, she is co-lead of the funds team and participates extensively in the capital formation efforts of the firm. She's also the brains behind establishing the investment team's database, which they call the Mine, and balances the promise that frontier technologies offer with the financial returns LPs desire. For those less familiar, Top Tier itself has more than $7 billion of assets under management and has invested in over 350 funds worldwide. They also have direct and indirect exposure to more than 10,000 portfolio companies spanning biotech, SaaS, and Web3, just to name a few areas. As for Jessica, she is a fellow LP co-investor I've admired and enjoyed working with for quite some time now. She's been investing for multiple decades, where she's watched a number of venture cycles come and go. And I'm hoping she'll tell us what she's observed as she's watched franchise funds get created, build on, and maintain their status. We'll also talk about what happens when things have gone not so well and funds have lost their franchise status. So what can she tell us about reaching the most exclusive club in investing? Let's find out. Jessica, thank you so much for coming on Origins. I'm really excited to dig into the topic of franchise funds with you and get your perspective on what it takes to become one, stay one, how to not lose your status. And frankly, I also want to start with the very definition of what a franchise fund is, because I don't think it's universally understood or everyone uses the same one. But before all that, I wanted to give you an opportunity to tell us a little bit about your background and how long you've been with Top Tier.
Thank you, Beezer. Thanks for having us. So my background is mostly from the analytical side. So I have a degree in math and economics, and I've tried to pull that through to what we're doing at Top Tier. But I started in 2005 with our predecessor firm called Capital Partners. And we're a fund of funds and secondary buyer. And so there's a lot of different ways to use analytics in that. But I figured out pretty early on, after working at a venture fund in the biotech space for a couple of years, that I was not going to be good as a VC. I didn't want to take on the kind of risk that at least early stage VCs have to take on. And as a math major, understanding science was not going to be a long career for me. And so Top Tier ended up being, a good opportunity to kind of balance analytics, relationship building, longer term investments.
And you've been doing this now. We chatted, was it only a month ago that we were at?
It feels like it was
Disrupt?
6 months ago.
Maybe it was 2 months. It does feel like 6 months.
Let's round it to 2 months.
Yeah, you've been now at Top Tier now for, I want to say, close to 2 decades.
Yeah, it's going to be 20 years in March. Not that I'm counting.
Happy almost anniversary.
Thank you.
And this is great because I actually didn't know you were a math major, but this does not surprise me because you're highly analytical and also layer in that a lot of insights. And I know at Top Tier, you guys, because we've talked about this, care about digging into the data as much as we do. And we love to geek out together on this. So I'm going to share some fun graduation thoughts with you, and then we can chat about it. But what we were looking at in the context of franchise funds is if you look at, and I'm just going to define this a bit for those who might not know the term fund graduation rates. We've been looking at that in our database, and that means what percentage of funds matriculate from one vintage to the next, right? Like who can raise subsequent funds. And when we did the math on how many active venture funds there are in the market at any time, coupled with the odds of fundraising vintage over vintage, we got to this rather depressing number, which is your overall odds of going from a first-time fund to a franchise fund is probably 1% or less, which is why we're doing a series on this and why I'm so excited to chat with you, because I was also making a list of who I think maybe the 40 to 50 active franchise funds are at any time. And I found even getting a specific number was challenging because the definition, I think, is a little bit fuzzy depending on the LP perspective or maybe the GP perspective. So here's where I'm going to bring you in. And I want to chat with you about the franchise funds, not starting with the number specifically, but how do you define a franchise fund? And what does it mean to you when you're looking at one? And we'll start with that and unpack it from there.
Yeah, for us, franchise funds, I mean, the easiest way that we describe it is they don't have troubles fundraising. I mean, that's kind of the first cut. Do they have the relationships with their LPs such that they just don't struggle to fundraise? It means that the LPs are happy. There's a lot of them coming back into the next fund. Even if some LPs, like in today's market, need to decrease their allocation, there's no problem filling that spot. So the LPs need to do their work, but the VC doesn't have problems fundraising. That's one for us. Now, to get to that, obviously, there's performance, right? And the stability of returns and consistency of the team and all those things that come into play. But I think the overarching definition for us is usually, fundraising ability, quite honestly.
What I'm playing with in my head is, well, what's the devil's advocate contrarian thing? Like, could you be a fund 3 and be franchised? Because we know some allocation constrained fund 3 or 4s, but I'm assuming you don't really mean that. You mean probably more like a 7, 8 because the performance part
the performance
takes time.
Part. Yeah, because I think I agree with you, because I think if you dig into the performance part, kind of another way to think about it is if we grade across a couple different metrics. Like if we're evaluating a fund, whether they're a franchise fund or a not franchise fund, if you look at the different metrics that we're evaluating off of, there could be, fundraising ability, there could be distributions, like what does their DPI look like? What does their TVPI look like? What does their projected TVPI look like? We look at, valuation policies. Are their valuations high or low compared to their co-investors? So are they inflating their valuations or not? Team, have they, gone through successions if needed yet? Is it a stable team? What percentage of partners have gone on to go do other things? Spin outs can be good, but is it also a sign of a bigger problem? How many of the partners that were added to the fund came from within versus did they lose all of their people? They're great at training, they promote them up, and then they get picked off. And so they have to hire in at the top. So if we grade across all of those, like you're in school, A minus, B plus, the franchise players typically have, A's or A minuses across all of those.
You use A, B, C, and D? Did you really?
Yeah.
I didn't know that.
Yeah.
That's awesome.
Yeah. And then you grade them. And it could be like, oh, they've got, maybe they have an A minus as a grade, and that A minus might have come because they're all A's and a C. You might still say no to that. Like, what if the C, because we don't weight it, we don't get too technical, but what if the C is in, I don't know, distributions, and we really care about distributions, right? So it's not necessarily what's the ending grade, but it's more of a way to evaluate across a handful of key metrics. How are they doing? So it kind of forces you to go gather that information, some of it qualitative, some of it quantitative.
So when I was making my list of who I think are franchise funds today, I was thinking through some of the things you were talking about, which is the ability to fundraise. And it's interesting because to be honest, I kind of did a swag because I was like, well, I can think of 25 off the top of my head, but I don't know if they're all, if you are a very large allocator of capital, say you're a very large pension, you might not have heard of some of these smaller seed funds that I still think have franchise status, because if you're sort of a venture geek like I am, I don't know if you want to be a self-proclaimed geek too, we know these names and they have no problems fundraising, but they're not Sequoia level of globally everybody knows the name. Does that factor into your thinking too?
It does. And that's where, if we look at their performance, that's where it kind of comes in, especially on the DPI, on the distributed numbers, right? Because they could be a fund 3 and do really well across all of that. They haven't had to have a succession before. They haven't, they have a stable team because it hasn't had time for anybody to leave. They can fundraise. Maybe they've got great TVPI because they've had some write-ups. But if they're missing that distribution number, that's typically, honestly, I think where LPs tend to recognize the VCs. Like once they have high distribution numbers, I feel like they get the buzz in the industry that then raises that awareness amongst the pensions and globally and foreign investors. And so I think you're right. I think there's some of those more emerging managers that maybe are doing well in the minds of those of us that are very active in the space, but they haven't quite graduated to that next level where, everybody knows about them, for example.
Here's a thought bubble. If it takes on average 10 years for a fund to return itself one time, I'm assuming, but maybe I should ask this, to be a franchise fund, one also has to have extraordinary performance, which is kind of table stakes. But that means that probably as a firm, you have to be over a decade old. So We're thinking it's 2024. You couldn't be any younger than 2014. And even then, probably not really. So there probably aren't. Are there any new franchise funds getting started now? I mean, there aren't a lot of exits. So I sort of feel like the market, this is a bit of a market thing today. It feels to me a lot. And one of the things I didn't talk about in the beginning, but it's been in the back of my head, is the fundraising of this year. And you see the same names coming back up again and again for getting all the dollars. And my thought is these two things are correlated because LPs don't have time to see DPI from anybody else. We just have the old stories.
Yeah, I mean, it's an interesting dilemma because I think what we are seeing increasing around now, maybe because of what we just talked about, is the liquidity solutions, on the secondary side. You very definitely could have a fund 3 that they had an early acquisition. They're the anomaly. They had the early acquisition. It was a small fund. It distributed 1x. So great. So there could be the exception. But I think by and large, you're right. Like it typically, takes 9 or 10 years. And so they have to be 9 or 10 years old. But I wonder what happens in today's world where we're seeing, especially some of those more emerging managers coming to us and looking to get enough liquidity in their fund to get to 1x DPI because they know they need to go fundraise next year. And so they're trying to manufacture that liquidity to get the capital back to their investors. So I have a hunch that for those who become franchise players, some portion of them will have created the liquidity on their own to get that awareness because they created that DPI. And I think, there's a good and a bad to it. I think the good to it is, look, your investors are tight on capital. So it gets money back to your LPs so that then they're playing with house money, right? You say, I've already given you 1x, so you can roll that into the next commitment of my fund. So, okay, that helps them. If it's coming from the right reason, right? So not just I'm going to sell to force this DPI, but maybe it's, I have 2 companies that are outliers in my fund and I'm trying to de-risk my portfolio. And there's an opportunity to sell, 10% of that company or 10% of a couple companies. So I think there's reasons and there's ways that it could be used effectively. And so I wonder whether that then is going to impact some of the benchmarks for DPI because if people are creating their own liquidity in a market like this, that's going to be very different than, VCs that don't want to create that liquidity because maybe they don't have to.
Oh, so interesting. So, I have so many questions. Let me start with this one. Do you have maybe you do because you've got grades. Is there a DPI number somebody has to hit to be considered extraordinary? Because I'm sort of going to couple extraordinary and franchise possible in the same thought, right?
We kind of underwrite, I guess, to a 1x DPI in 9 years. The 9 years is somewhat arbitrary. It's from looking at, like you did, looking at kind of the averages, and it's anywhere from 8 to 10, depending on the market. And so we put that in there in part because we were finding some of our seed stage managers, both tech and healthcare, were taking like 12 years. Mm-hmm. And that, especially for somebody like us who's a fund of funds, that doesn't work. We can't wait that long to get to 1x DPI because our funds are only 15 years, including the extensions. And so you take 12 years to get to 1x, it's probably going to be hard to then wind that whole thing down. So for us, so it's somewhat arbitrary, but I do think that a lot of the pensions and endowments are also focused on that kind of same time. Even though they don't have a closed-end fund, I think they also, they don't want to wait 12 years to get their money back. The IRR will just be terrible. If somebody can deliver a 1x in like less than 6 years, 5 or 6 years, I think that's definitely extraordinary. I think in that 5 to 6 to 9 to 10 years, you'll certainly get our attention. for sure. Especially in a market like that. I mean, it's somewhat market dependent, right? Especially if you can do that in a market like this, like great for you because nobody else is.
So when you look at a fund, it's less the overall fund return. It's really the 8 or 9 year cycle.
It's the timing of the timing of the performance, I think is a good way to say it.
Gotcha.
And it comes into a couple different, interesting areas because, and I think this gets back to, what makes a franchise player may be different depending on who the LP is, right? We as a fund of funds, as a closed-end fund of funds with a preferred return, so we care when we get distributions. That's going to be very different than an incredibly long-term pension fund or even a foundation that needs predictable cash flows. And so I think, what might work for us might be different than what works for somebody else. But because of our structure, we do care about the timing of our distributions. And so if you think of the preferred return, kind of the European waterfall, timing of distributions matters. So we want faster liquidity, but also being a closed-end fund, at the end of the 15 years, we need to have that, we take a very strong view that we have a contract with our investors for 15 years. It's really 12, no more than 15. So we have to end it in 15. That's our belief. We're going to stick by it. So we use secondary sales once we get into the extension period. So after 12 years, we'll start evaluating. If a manager has a high TVPI, that's also okay for us because we can take a discount off of that when we sell, but we'll price that in or underwrite that in as we underwrite. So it's okay if you can get a high TVPI, but we're going to have to assume whatever might be left by year 12 or 13, let's assume something big like a 40% discount. Can you still make that 3x net performance that we want after we have to go through that secondary sale? Timing of distributions matters to us, but also we're going to assume we're going to sell at the end. So it's not just like, hey, can you underwrite to a 3x in 20 years?
Great point. And then that also speaks to the second question I was going to ask you as a follow-up. Can you become a franchise fund exceptional performance status by doing secondaries? And if the answer is a 1x in 6 to 8 years, maybe, right? Because I don't know if you can 3x your fund. There's a lot of capital going into secondaries. It's still not as big as the IPO market. Right. So I don't know if you can get a 10x, but you could 1x in 6 years or 8 years. So maybe the answer is yes.
I think it certainly helps you. I mean, that's why I say, like, with secondary sales, there's a good and a bad side to it. There's a bad side in that are you forcing liquidity, but you're capping your upside? Mm-hmm. And what are you doing with the investors that don't care about the timing of liquidity? They just need capital in the ground. So I think there's a balance to those. But I do think, if you've got, I think there's a use case for it, because if you've got a company that's, staying private, the CEO maybe doesn't want to go public, you got in the seed stage or pre-seed, it's now 12 years old, maybe it's 7 years old, whatever it is, it's, 90% of the NAV in your fund, it might be a good thing to take some liquidity in that. Because as we know, especially in these markets, if you've got some debt issues or your consumer play and the consumer trends change, like I would hate for that company that's 90% of your portfolio and going to make you a franchise play because it's going to just make so much money for all your investors. And then something happened to that company and it goes to zero or near zero. You should have taken, money off the table. There's a manager we're in that they're probably fund 5 now. This is their fund 2, and they've got a company in there that's like that. And they're evaluating, should we take something off the table? It's 9x of their 10x fund.
Wow.
On an unrealized standpoint, like I'd love for them to take 3x off the table. Then there's zero distributions in the fund because it's so much of it is in that company. If they could sell some in the secondary market, you take, even if it's at a 50% discount, right? Take 3x off the table, you still have plenty to let that company run, as well as all the other companies. So I think there's a use case for it, but I don't know that people should rely on the secondary market to make a great fund.
Oh, I'm so curious to hear what happens with that, because that's pretty impressive.
Me too.
It's like, how's the conversation going? Are they open to it?
But I think that's also part of it. If you think of the franchise funds is where's that communication, right? Are they having that conversation with their advisory board? What do you guys think we should do? Should we do this? Should we not? What's your advice? What's your preference? What have you seen other groups do? Like, I think the managers that are willing to use their advisory board as advisors and not just, I have to check a box and go report to them. Like, we're on a couple advisory boards of managers I think are incredibly well run, and they're soliciting advice every time we talk to them. They don't have to take it, but they're at least being proactive and asking, or, you know, voicing their concerns. You know, we think this is what we might do. What are you guys seeing? So I think just engaging in that conversation is helpful too.
I don't know if it's causation or correlation, but are there other connective points where you said, in folks that you see get to this 1x in 6 to 8 years, strong communication with LPAC is one of the hallmarks. Are there other ones that you see sort of consistency in the data that, or in your experience working with funds?
I think communication is definitely one. I think you could define it as culture, but understanding that they're managing other people's money. It may be a way to weed people out. I'm not sure. But I think there's some of our managers that are on the cusp of becoming a franchise manager, except they really don't want to talk to their LPs. You know, that LPAC it's a forced function, or they don't hold the LPAC because they don't have to. And I don't want to sound egotistical, like they must take our advice, but more, there's no communication. You know, they come, they fundraise, they give a short period of time to fundraise. You know, there's no extra information provided. They don't want to talk in the off cycle, you know, and you just kind of feel like it's not our money. It's like our money comes from, you know, pensions and endowments, and it's their money. But the VC is so focused on the entrepreneurs that I think they at times forget where the money comes from. And so I think that could make you fall out even if you do have performance. And it kind of brings up a manager of ours that, you know, we started investing, I think it was Fund 2 or Fund 3. Like, they're definitely in the emerging space. And I would put them in the franchise category now because, I mean, performance is good across the board, right? It's consistent performance. They distribute, but, you know, they communicate with us. They, you know, I think know almost everybody on our investment team. We have 20 people on our investment team, and somebody at that manager knows at least somebody on our team at the doing of the manager. Like, they've made it a point to say, we don't want to have just a relationship with Jessica. What if she retires? There goes the relationship. So they've put the effort in to build the relationship with us, to help us, you know, I don't know, introduce us to LPs, or, you know, co-investments, or, you know, hey, we're hosting an event. Do you guys want to come? Or, you know, put in a good word for it, whatever it is, but it's that partnership on both sides. Then I think you get that attention from the LPs because you're top of mind for them. And so I think it's more of a cultural aspect to it that is kind of the qualitative side of things.
I agree with you. I think sometimes in the pursuit of the next great founder, people get too busy, forget, or whatever the right word is that the LPs need to feel comfortable. Right. And you can actually facilitate your fundraising if LPs are comfortable. I wouldn't necessarily say people are willing to take less performance, but I think people are more empathetic.
I think people are more empathetic. And if you think of, you know, who are the typical investors in venture, whether they come through a fund of funds or not, you know, the ultimate source of capital, you know, if you're a pension fund, you have to answer to the retirees, to your board, right? So if you're an endowment, you're going to have to answer to the trustees, like even if you're a family office, you're answering to the principal or possibly yourself. And so I think understanding what's going on in that performance.
Yeah.
You know, especially in a market like this, when times get tough, you want to know what's happening to my capital. I don't actually care what the unrealized performance says. That's a good indicator, but it's unrealized performance, and people can make up the valuations, right? I mean, they're private companies. Like, that's the benefit. But I think, again, that comes back to that communication, that transparency. The more communication you have, the more relationships, there's a comfort level there. I trust these people that they're doing the right thing. I trust that everything's okay because I talk to them all the time. I talk to them, whatever the frequency is, quarterly or monthly or semi-annually, but I have this level of information that provides comfort. So again, whether you're a fund of funds or say you're a pension fund, I think it's still information gives you comfort. And so, understanding that I think is an important part of it. And again, that's not even related to performance.
No, but let's chat about performance. So I realize this is a very generalist statement, so feel free to parse it up however it works. When you think through your experience of the franchise funds you've worked with, can you achieve that? Not with any strategy, but are there ranges of strategies, or in your experience, is it more the concentrated strategies, right? Because we see different ones in the market. Is it mostly early stage? Is it growth? We definitely see the collaborative, smaller seed funds. Do you see any through lines, or maybe not? And maybe not's a great answer because it means people can be creative. But I suspect math is math.
It's a great question. So I went and looked at our top 20 venture funds by TVPI. So 20 years, what are the top 20? And it was a hodgepodge. There's some big brand names that I think we would all agree are franchise funds. There's some of our emerging managers. And again, this was just TVPI, so it did not look at the distribution numbers, but they were, they're, I don't know, 8, I think 6X was the lowest. That was the cutoff for the top 20. And so you would assume, a lot of them do have some distributions. There were, of the 20, I think there were 3 healthcare funds, the rest being tech. There were a couple in Europe, mostly US. As I said, some emerging, some franchise. So, it was interesting. I was expecting to see a lot more of the kind of bigger brand names that were older, had more kind of funds under their belt to deliver that performance, but it was a little bit across the board. And so what we did was then we dug into it. We went and looked at those top 20 funds and kind of came from a little bit different angle and said, we underwrite to a 3X net. What's the common theme amongst the 3X net funds in our portfolio? And we actually did this in combination with an endowment in the US where we took kind of their 20 years of data, our 20 years of data. So it was something like 400 or 500 venture funds in there. And we found that 85% of them had at least one company that could return their whole fund. And that got them 3X. And there was an incredibly strong correlation. 2 fund returners got you a 5X, 3 fund returners got you a 10X. Like it was incredibly correlated amongst that. So then if you go back and look at those fund returners, on average, they owned 10% at exit.
Wow.
So that was the biggest surprise. Like I wasn't surprised by the fund returner, but owning 10% at exit, like that's after you've been diluted. So, and again, it can come from, some of these growthier like funds ended up owning a bunch of capital in those funds that you just really didn't, we're all focused on the exits. We didn't realize like, oh my gosh, they own 12% of that company at exit. So for me, it comes back down to the math. Right. So if you can own 10% of a company that can return your fund, you've got that 1X. That might take 10 or 11 years, but you've got 1X. Then you've got all of your other companies, 30, 40, 50, however many it is, to deliver the other 2X. You're well on your way. But if you don't have that company that can return 1X, you're trying to cobble it together with a bunch of, kind of 20% of your fund, 30% of your fund. That's just really hard because if you've got a bunch of companies that are going to return 20% of your fund. Maybe you have 30 companies in total. Right there, you've taken 5 of them at 20% each to get to that 1X. You just don't have that many left. And, on average, our funds have about a 20% loss ratio. Mm-hmm. So right there, you have to say 20% goes away. Assume they recycle their 20% of management fees, right? So 20% of your portfolio is going to be losses. You're only dealing with 80%. You have to have some kind of big outcome.
Was there any commonality in fund size? Because I'm thinking smaller funds might have a struggle to get 10%. At least I would say many folks, the smaller seed funds we talk to aspire to get 10% at initial-ish, right? Maybe bought up a little bit between seed and A.
Yeah.
But that means you're going to be diluted unless your company gets bought the nanosecond later, right? Math is math and you're going to be diluted.
Yeah, there were two things that came out. One was over about 750 million in fund size.
Really? That
it got really hard. And I don't know whether it's because the funds that are, say, $1 billion and greater are just too young.
Oh,
right?
wait, sorry. So let me get this right. You said over 750, it was hard to see this math working, even though you have the check size sufficiently to own a big chunk.
And I think part of it is, I mean, if you just round it off to $1 billion fund, right? If you're going to own 10%, you need to own 10% of a $10 billion outcome. There's just not many $10 billion outcomes. So even if you own 10%, how many $10 billion outcomes are out there? And then what's your market share of those outcomes? So I think that's why that got hard. But I don't know whether, how the data was skewed, because the $1 billion funds really became much more popular probably 6, 7, 8 years. I mean, it was pre-pandemic, so maybe 8 or 9 years ago. So are they really old enough to have seen those outcomes yet? But I think, we've started to pull back from some of the larger funds because of that math. We just think that the mega outcomes are probably a dwindling market, certainly for the next couple of years. But then on the other side of it, on the smaller fund size, I think the math is still the math. So you probably don't need to own 10%.
Mm-hmm. Yeah.
You need a fund returner. So if you're a $50 million fund and you can own 5% of a bigger outcome, great. And I think that's what we see some of those smaller funds getting into one of those great companies so early at such a low valuation that even if they only own 5 or 6 or 7%, it's still, if it's $1 billion outcome and you own 5%, like, good for you. That's going to do wonders for your fund.
Are there other things that you've noticed that speak to sort of let's call it the maintaining of franchise status? Because maybe it's team development, sharing carry, not always as easy as it sounds, expansion of strategies, things that people have done that have maintained it. And then we can move into when is it not work so well? And I do think people actually, what's the right word? Exit franchise status sometimes.
They do.
But over time, to the point you made me think about is you have to, you keep going. And what is it keeping on going looking like? Do people just stay really small and consistent? Have you seen people expand successfully? Any hallmarks?
The consistency of, I don't know, the grading, who they are, however you want to define it. I think the consistency is the most important part, right? So if, thinking of, your franchise manager and then, time passes, maybe your performance starts to kind of dwindle, you can get it back, right? It's such a long-term game. It's okay if you have one fund or a couple funds that don't work out over time. But if it's consistently now you've dropped down, that's where we start to have concern. And what we've seen with people kind of or venture funds kind of dropping out of that has been almost like if they stay too consistent and they're not evolving with the market, right? Well, this used to be good enough. And a good example is like a 2.5x fund. That used to be a great fund. 20 years ago, if we could get a 2x net venture fund, we're like, this is awesome. We all went to China because we couldn't get 2.5x here. No, that's not good enough anymore because the market has moved to more like a 3x. I think the same thing on distributions. It used to be okay to wait until companies went public. Now we're seeing groups start to manufacture their own liquidity. And so it's like you have to keep up with the market and evolve with the market. And so I think that's one way that people or venture funds kind of drop out of that franchise status. For us, it's also if they kind of get too greedy, maybe is a good way to define it. Like fund size increases too much or too much of a expansion of strategy. When we underwrite, we look at what's the go forward team, go forward strategy, right? So if all of a sudden now you want, this fund and this fund and this fund and this fund, you used to have one fund and then you added a select fund and now you've got all of these other funds under it. You start to question, like, is that still what drove the historical performance? And so I think you have to be careful with that. It's, is it perceived to be a management fee grab and you're getting greedy? Mm-hmm. I think the same thing happens. You can anger LPs pretty quickly if you try and increase your carry too quickly before you've earned it. We had an emerging manager come into our office asking for 40% carry, which ended that meeting pretty quickly. And they were just unfortunately given bad advice. They had no idea, and they were given bad advice from some lawyer that was not a lawyer any of us had ever heard from, right? And that was our response. We're like,
That's a bummer.
Which was it was a big bummer because I think it ended so many meetings for them that people were then just like, you know what, I don't want to go forward. Even if you change your terms, like, really? You're that clueless? Like, but maybe they had a good case. Maybe they had a good background and make a good case for a new manager. We've also seen one more recently that asked for 30% carry, but they're going from 20%, now they want 30%. Their performance just isn't there yet. But they were like, all of our peers have 30%. I'm like, yeah, but they've given money back to investors and they've delivered on their performance. So I think that's a way to just, I don't know, rub people the wrong way. You got to earn it.
Speaking of earning it, so I was chatting with Stephen Bluestein, who was Packard Foundation, now Adam Street. And he talked about you have to earn the right to always be on the cap table of the best founders. That was part of his sort of franchise definition. And that resonated with me. Mm-hmm. And it made me think of your comment about how to keep up with the market, both from an LP perspective, but also what do founders want? Because I've seen this disconnect where sometimes founders will say, oh my God, XYZ is this great investor. And you're like, that is so true from your perspective, but not always from an LP perspective. But maybe for franchise funds, it needs to be true for both. I don't know, just sort of curious your perspective on how you earn your right.
Yeah, no, that's a good point. I think it probably does need to be true for both. I mean, because it's the chicken and the egg, right? Like, you're not going to get the good deal flow from LPs. Let's be honest, right? So, you're going to get the deal flow from being, important to the founders and the entrepreneurs and value add, but your money comes from the LPs. And so you got to kind of make both areas happy. And I think what we're seeing on the co-invest side is, some kind of driven by the market, some tricky boardroom dynamics, which I think could damage some of the reputations of the managers. So you could be a franchise manager and then, start to get a couple of chinks in the armor, because if you think of today's market, like if you just came in, like I think you and I are in a manager together where this was just the case where, you're an early stage investor in a company had to take on some debt to be able to grow, to keep up with the market. Well, now the debt needs to be reserviced, and the kind of growth manager that came in has different terms. They're okay with it. They just started their clock and they're looking for returns and they're fine with it. But the early stage guys have been crammed down so much, management has been diluted so much that the company could go to zero, or you could restructure the cap table and the company could continue on. But everybody in the boardroom is coming from very different return profiles. They're not aligned anymore. And so they actually went and restructured that cap table to make more alignment, which meant that everybody had to give up something. And I think in a market like this, you could potentially see people maybe with bigger checkbooks where this company doesn't really matter to their performance because they have either their own good personal performance within their franchise or the franchise itself has good performance. What's this company? Fine. It goes out like whatever. It's one of 30 companies in my track record. Do they act a little bit differently than the not franchise player who really needs this company? This is going to be their franchise play. This is going to send them into franchise territory. It's going to be different. And we had a manager that a couple of years, it was probably 2 years ago, there was an exit on the table, an acquisition on the table. And one manager who came in later, so had kind of more voting rights, blocked it. And the company ended up going completely to zero.
Wow.
And it's like, okay, that's not good for anybody. We could have taken, a lesser outcome and still gotten an outcome. But, they've got 100 companies in their portfolio. They didn't care.
There's always this question,
so I think there's,
right?
I think with this market, it'll be interesting because I think there's some franchise funds that could drop out of franchisedom because either too big, we're seeing funds decrease their fund size or maintain fund, so again, if you're doing anything against the market, so growing a lot more than your peers are in fund size, or your terms more egregious than your peers, so you got to kind of be in tune with what's everybody else doing. Not that you need to follow them per se, but you don't want to be an outlier on either end.
I know you guys are so thoughtful about succession. And in my head, I keep debating, are you a franchise fund if you haven't figured out some level of succession? Because it is so incredibly hard. I don't know. That's why I sort of swagged it at like 40 to 50, because I was like, there's some like, what do they call it? Like a emerging franchise, because they're in the throes of thinking about succession, versus firms that are 40 or 50 years old, in which case, they've had to figure it out, or they don't work. Right. I think so. Are there hallmarks that you've seen in how people do succession well? And then the I gotchas, because I fear there's a lot more I gotchas than there are positive signals, which is, I don't like being negative on these things. I just think it's not done well most of the time. And we don't see it on the outside, but you can feel it on the inside.
I think it is incredibly hard. I think if you look at some of the managers that have just said, I don't want to have a succession, like we're just not going to raise another fund. I think that's somewhat of an indicator of how hard it is. I think you see some that don't do it well and therefore just kind of dwindle, the zombie funds or whatever you want to call them. They just kind of dwindle away and then ultimately don't raise another fund. I think if we look back across our funds, there have been a couple instances where the market has told them they should maybe make some changes. And I think that's almost like the kiss of death. If you go out to raise a fund and nobody shows up, or, 40% of your LPs come back, you've done something wrong, right? And you're out of tune with what the LPs want. I think that's very hard to recover from. So that's kind of one of the fears, I guess. But if you can get ahead of it, and again, it goes back to, if you've communicated well with your LPs, somebody leaves, you're like, hey, we're good because we have all these other relationships with you. We've telegraphed that this person is probably going to be stepping back. I think we only have one manager that has a mandatory retirement age. The rest of them don't. So the rest of them, it's somewhat arbitrary. One of our managers is very not only one, but at least one is very formulaic. They look at, what performance have you delivered in the last fund cycle, and the best performance wins. And if you haven't delivered some threshold, then you're out, which is kind of a way to do it on an individual level if you've fallen out of that right to be on a cap table, right? Something's not working for you, whether it's you're not finding the great deals or you're not winning them or whatever it is. And so they kind of phase people out. But I think it is hard. I mean, I think some of the managers that have been around for 30 or 40 years are probably good examples of it. If you think of, any number of kind of the old Sand Hill Road guys, they wouldn't be here if they hadn't done succession right.
Sometimes I think succession breaks because of old school human greed, and people don't want to share economics sufficiently to retain the up and coming talent, just to start with the negative.
Yep.
And then I'm going to get even more negative. Wait for it. Which I know is not usual for me, but the longer I spend in venture, the more I wonder how many extraordinary pickers there really are.
Yeah.
And if part of what launches these franchise funds is some sort of, I don't know, some wonderful catalytic reaction between the people that are investing, how hard that is to then build the team, especially if you use this model of kind of what have you done in the last fund cycle, because maybe there's some folks who are just always phenomenal, but I'm betting there's some folks who come and go a bit. And then how do you pick them? And then how do you give them your firm? I don't know. What's your experience? How negative am I on there are not that many extraordinary pickers? Or can you team baseball it?
I think you're pretty realistic. So kind of 2 points. One is on the human greed. I think, it's natural. I agree with you. I think it's natural. It's a natural part of it. Personally, maybe it's because I'm a math major. I think, again, the more formulaic, probably the better. If there's there's another one of our franchise managers is like formulaic. I don't remember the exact thing. It's like a weighted, you basically get points for the funds that you're investing. So if you start to retire and you invest less of the next fund, you get fewer points of that, fewer points of carry, fewer points in the management company. But also as you're coming up in the organization, you gain points because you're investing more of a fund. So you kind of get staggered based off of how active you are. And it all adds up to 100%, and that's how they define it. So it's not necessarily performance related of those outcomes, but if you got it through the investment committee, it's on all of us. We're going to prove it that way. So I think that's a lot less ambiguous. And so I think that's probably easier to then retain talent, grow them up. They know what they're going to get. As you leave, you know what you're going to get. So I feel like there's less fighting as a result, because everybody knows this is the formula, this is the pattern. And it probably doesn't have to be formulaic, but in terms of a numerical outcome, but more just this is our pattern. This is what we're going to do. You know, we've had a couple partners retire, and it's let's do it when it's not emotional. Let's agree now. We all know, all of the current partners know what happens when we retire. And so then you're not fighting with it. You know, like, hey, when I want to tap out, I can tap out, and this is what I'm going to get. There's no debate around it. And so I think that's one side of it. But then the skeptical side of me on the market in general is around stock pickers, for sure. If what I worry about is the number of new funds that have gotten created in the last decade and continue to get created. Why didn't you go join an existing fund? Are you that smart and that different and that special that you need to go raise your own fund? If you are, that's great, and we'll probably want to back you. But the flip side of it is you're just spreading out all those really good stock pickers. You're forcing more diversification than anybody needs. Because before, when we had really good performance before, there were maybe, think back to the 80s and 90s, right? There were, 10 good venture funds that everybody could name. All the good stock pickers were there. Now, like as you say, there's probably 40 or 50. And so we used to need 10 in our portfolio. Now we need 40 to 50. Is it going to 80 to 100? And so I kind of worry about that, of just the dilution of the stock picking. It's the all-star team is kind of the notion.
Yes, I constantly,
It's the participation award that everybody gets in school now.
Yes.
You have to have a bunch of winners.
No, I catch myself saying frequently, I would like to fantasy football this and take this person from here and this person from there and squish it together because they're very good at this and they're very good at that. And sometimes the overall fund structure that they're in doesn't lend that one choice to be as strong as it could be when you look at it.
So we actually did that at one offsite, is we created a fantasy football thing for VCs. And it didn't last very long because it just takes so long to find out those outcomes. But it was like, if you could put together a fund, who would the people be and which of their investments do you want to track? And so it was like, I think you could choose funds that were in the last 3 years. So you knew a little bit about the funds already, but not a ton about the performance, but you could choose the companies in there. And then we competed, because we compete on everything, across who has the best fund. And so you'd get an outcome and you're like, oh, I had that company in my portfolio through this person. And then there'd be a failure and you'd live in, but you won't know for 10 years which of those employees were good stock pickers either. But
I'm curious, given what coming up the end of the year and the start of a new year, any sort of big guidance for venture funds? And you've seen this rodeo, right, come up and down, and hopefully we're coming back into better times than not so much. But I don't know, my crystal ball is hazy. What are you thinking about in the venture landscape?
Yeah, I mean, I think we're a lot more optimistic than we have been, just in venture in general. I think, capital call rates are increasing. So the smart money is finding good deals. I would take advantage of the liquidity when it comes. I think what we're finding is those that didn't take advantage of the last liquidity window are regretting it. And so even if there's a little opening, don't wait for the best possible outcome if that's going to risk the company. If it's IPO, you got to, rely more on the bankers and is it truly an IPO-able company and stuff like that. But I think if there's some acquisitions, I'd love for people to take, an A- deal as opposed to waiting for an A+ deal. I think be a little bit conservative on that. And then just get ahead of the calendar. If you're out fundraising, I think, allocations are lower in general. And so people are probably done with their allocate. Anybody that has an annual allocation is probably done mid-year, second or third quarter. So if you're going to raise in the fourth quarter, I'd make sure they protect that allocation for you. And so just communicate early if you're going to be fundraising. And the more information you can give LPs, the better.
So not too soon for someone to tell 12 months in advance, I'm planning to come back at this quarter. Please hold on?
I don't think it's too soon. At least let us know, like, hey, we plan to be back. There's a couple different, data or dates in mind. So it's, we're going to come back with a data room here, or we're going to have a first close here, or we're going to have a final close here. Please don't raise your fund 18 months before you need the money, or 12 months before you need the money, because, we're going to allocate it now. We'd like you to start deploying it close to now. But yeah, I think 12 months in advance, or at least, kind of calendar year. I think people are in planning mode.
And you said you feel more optimistic. Besides seeing the capital calls, what else is giving you some optimism? Because I want to end on a happy note after all of my negativity. So you can bring the optimism.
we just had our annual meeting a couple of weeks ago, and we're definitely more optimistic. So capital call rates are increasing, which is always a good sign. We're starting to see more exits. We're starting to see more M&A exits, like deals actually happening, as well as M&A interest. And it feels like every manager we talk to has got at least a company that's filing to go public, or has filed to go public, or IPO ready. So that verbiage is coming back into the discussions. We went and looked at our distributions for the year, and normally they're about 25%. Actually, I'm not sure of the number, but when we went back and looked at our distributions for the year, I was surprised that half of them were from M&A.
Wow. Me too.
I would have thought no M&A. You just don't read about them. But they were $200, $300 million deals.
Gotcha.
And that's adding up. And our distributions for the year have been kind of like average if you take steady state over a long period of time. I mean, obviously, we're managing more money. Distributions should be higher. But so it's not like it was a really dry year by any means. And half were from just these kind of small doubles and triples, so to speak. And then half were from public stocks that were stocks that by and large went public 2 or 3 years ago. And they were maybe in the lockup still in the lockup when the market corrected. So you watched it go down. Now they've come back. The public markets are actually doing quite well, right? They're hitting all-time highs. I mean, if you go actually look at the Russell Investments website, they do a really good job with that emotional curve, of like fear and depression and all that type stuff. And they tied it to the returns of the S&P 500. And I was shocked when I read it that since the low in the S&P, it's up like 60% or something like that. You would not have thought that.
No.
And so they're like, we should be a lot more optimistic than we are. Public markets are doing well. Fine. We don't have a lot of distributions. Innovation is there, right? AI is a whole separate topic, but it's there. It's creating innovation across all these other sectors, healthcare, education, travel. So there's kind of no reason for us to be anything but optimistic.
Okay, I'm going to end on that because I love ending on a happy note, and I appreciate you bringing it in. That's awesome. I love it. Thank you so much for being on.
Of course, thank you.
Thanks for listening to Origins, the show where we discuss the venture ecosystem through the lens of a GP and an LP, and in today's case, 2 LP. Be sure to tune in next time for a bonus mini-sode where I'll unpack today's conversation with Jessica with the help of a very special guest host, my partner at Sapphire Partners, Laura Thompson. You can find that right here in this feed. And while you're there, please rate and review the podcast. It's super helpful for others looking for venture insights to find our show, and we truly value your insights and suggestions. I'm Beezer Clarkson, and on behalf of me and my GP co-host, Nick Charles, we'll be back soon. Thanks for listening.